When we think of China's rapid rise over the past 4 decades, the first thing that comes to mind is how it became the manufacturing hub of the world. From the late 1970s, China opened up its economy through market reforms, encouraged foreign companies to invest and build massive factories that exported cheap goods everywhere. This manufacturing boom created millions of jobs, raised incomes, and gave Chinese households the ability to save a large portion of what they earned. But behind this miracle was also another powerful engine, which is debt. Unlike the US, where the consumer borrowing drives growth, China's growth model has been fueled by heavy borrowing to build infrastructure, housing projects, and industries. Today, it is being said that the debt to GDP ratio of China is around 300%. So while China's success is real, it is also deeply tied to how much it has borrowed to finance that success. Economists use triangle trap to describe how three parts of Chinese economy are tightly bound together by debt, which causes the pressure in one corner to quickly spread to other. One corner is government, especially the local government. Another is state-owned enterprises and property developers, and this category is mainly related to the property sector. And the last corner is of households. Each of these corners has played a unique role in fueling China's rapid growth, but also in deepening its financial vulnerabilities. We will be talking about each of these one by one as we go ahead in the video. In China's political economic structure, the State Council, which is the central government, sets the overall economic direction and assigns GDP growth targets. These directives are passed down to the provincial governments, which are directly responsible for implementing Chinese vision and ensuring results. The provinces in turn push these targets onto the municipal and the local government, who actually execute most of the infrastructural and development projects. The local government officials have to achieve higher than average targets if they want promotion, prestige, and career advancement, no matter even if there are long-term risks of starting a particular project. The problem with local governments is that they are expected to deliver rapid growth but are not legally allowed to borrow directly. To overcome this, they create local government financing vehicles, LGFVs, which are a special purpose company that raise funds on their behalf. These LGFVs borrow heavily from state-owned banks. Banks also lend them easily because these LGFVs are backed by land provided by local governments and possible future revenues that will be earned, and it acts as a collateral to be kept with the bank. You might ask why the system is designed in such a way that the local governments are not allowed to borrow on their own but allowed when done through LGFVs. Because it is already creating another layer of bureaucracy and making it more complex. So the answer to that is that the creation of LGFVs was less about efficiency and more about control, accountability, and political risk management. In China's systems, the central government strictly prohibits the local governments from borrowing directly because it fears uncontrolled debt growth could threaten financial stability and weaken Beijing's grip over provinces. Allowing direct borrowing could empower local governments too much as compared to the central governments, and also would make debt risks more transparent, forcing the central government in China to either bail them out or let them default, and both are politically costly choices. So by creating LGFVs, the debt is pushed one step away from the government's balance sheet and is kept in the realm of corporate borrowing. This gives China plausible deniability, saying its companies' debts are not government debts. The bureaucracy may look complex, but it actually protects the central government's image, limits formal fiscal decentralization, and shifts debt risk into the shadowy gray zone where it can be managed, restructured, or hidden as needed. In short, LGFVs exist not only because they are efficient, but because they serve a political logic of centralized control with decentralized execution. execution. Thus, LGFVs are being run like state-owned enterprises to borrow money and fund infrastructural projects on government's behalf. The debts of LGFVs are piling up as many of the projects funded by the LGFVs do not generate enough revenue to cover their costs. Roads, bridges, and industrial parks often come with long-term benefits but do not provide immediate cash flows. As a result, local governments are forced to rely on fresh borrowings to service old debts. If I explain the other area where the debt crisis is lying, it is the property market in China. It has become a dangerous pressure point in the country's debt crisis. For 2 decades, real estate was the engine of China's growth. As the real estate was booming, the land was sold at high rates and it was source of revenue for the local government. The real estate also attracted massive investments and absorbed household savings. To reach GDP targets and to get quick revenue, more and more houses were built, leading to oversupply, and it created housing bubble that is now unraveling. Entire ghost cities stand as symbols of this oversupply, while developers such as Evergrande and Country Garden are buried under mountains of debt they can no longer service. The authorities were so obsessed with reaching GDP targets that projects got approved without proper economic viability checks like demand forecasts, population growth, or households' affordability were ignored. This is the problem with judging a country's progress only by looking at its GDP. From the outside, when we see China's GDP numbers, it appears that the country has developed at a rapid pace. But these headline figures hide the long-term consequences. GDP measures the total value of goods and services produced in a given year, but it does not ask whether those projects were economically sustainable. Even empty apartments or unused infrastructure still count as growth. The result is impressive numbers on paper but weak foundations in reality. Another layer of China's debt crisis comes from the Chinese households. These households are deeply entangled in the property-driven debt trap. Nearly 70% of household wealth in China is tied up in real estate. For years, families poured their savings into apartments, often taking a large loan from banks that they must repay over decades. But as developers default and projects stall, millions of middle-class households are left repaying these long-term housing loans on unfinished homes, a phenomena that triggered payment boycotts in 2022. At the same time, China's household debt to GDP ratio has climbed above 60%, showing how rapidly borrowing has grown. Instead of boosting consumption, families are now trapped in debt repayments and falling property values, making them both the victims and silent contributors to the broader debt crisis. There is also something we can't ignore, which is the fragility of China's banking system, especially the smaller and regional banks. These banks are heavily exposed to 2 very risky borrowers, which is the local government through LGFVs and the property sector. On paper, their loans may look fine, but the reality is that many of these loans are already in trouble. The actual number of non-performing loans, which are unlikely to ever be repaid, is almost certainly much higher than what is officially reported. And here is the real danger. If defaults start piling up, it could set off a chain reaction. A wave of defaults would not only shake confidence in the bank, but could also trigger bank runs where people rush to withdraw their savings, or even capital flight can happen where money starts leaving the country in fear. Now let's talk about the global impact of this kind of crisis. As China is the world's manufacturing hub, if its economy slows down, it means lower demand for raw materials like oil, copper, coal, and iron ore. That's bad news for major commodity exporters like Brazil, Australia, and parts of Africa, whose economies depend on selling to China. A slowdown also disrupts the global supply chains. These are the same supply chains that keep factories in the US, Europe, and Asia running. And there is the financial side, wherein the foreign investors and international banks which are involved with Chinese companies could face heavy losses. And here is where it gets even more dangerous. That if Beijing decides to defend its economy by selling off large amounts of US treasuries, which it holds in trillions, it could shake global bond markets and send shock waves through financial systems worldwide. In the worst case scenario, if all these pressures come together, we could be looking at the global financial crisis comparable to 2008, but this time with China at the center. So in the end, it can be said that even though China remains the world's second largest economy and a global manufacturing powerhouse, its debt crisis show that the size and growth don't automatically guarantee stability. Beneath the impressive numbers, there are still deep structural issues that need to be addressed. For India, the lesson is clear that real progress comes not just from fast growth, but from balanced and transparent growth. Hidden debts, overexpansion, and short-term fixes may look good in the moment, but they carry risks that eventually catch up. Sustainable development can only be assured on the basis of strong foundation. If you like the video, please hit the like button and subscribe to the channel and stay tuned for content like this. Thank you so much for watching the video.